Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. I'm scrolling through the comments section. I'm going to answer a lot of your guys' questions. That's just something I like to do. But there's one thing I wanted to start with so you guys kind of just get my opinion here is you guys are probably scouring the YouTube channels trying to find answers for your investment questions. One thing I wanted to touch on is, and it includes myself as well, is no one holds the future. They don't know the future. They don't know if these prices are going to go up or down. All you can do is basically what the thesis of the channel has done. I've searched very long, very hard, and kind of put this all together over the years of my investing. And it's basically finding value using ratios. Once you find value, you have to make sure that the market conditions are ripe for that value to swap to an undervalued to overvalued state. That deals with the real estate cycle or business cycle and how they impact interest rates, because that will determine the flow of money and how money flows from one asset to another asset. And you can go through all this other stuff, and really what I've done with the thesis is determined what the most or highest impact to the investments is, and it's really money flows. Money flows is what determines valuations of assets. And the changing of money flows is the market conditions changing the routing of that money. So if you listen to other channels, and it's completely fine to do that. I want you to do that. Try to look at it from that paradigm: money flows, market conditions, and how they navigate over time. Because the ratios is just telling you money's flown here, which is overvalued, and it has flown out of this one, which is undervalued. And what I'm doing is I'm scouring the world and saying, okay, these are the undervalued assets. This is what the market conditions look like. More than likely, they're going to flow into these assets. So I buy them up, I diversify out, and then I wait. And waiting is the most important part of this game, because that's where you make money. It's not making trades. It's not changing things. It's waiting and doing nothing. That's where you make the money. And that's where you have to be disciplined, and you have to know that your thesis or your strategy is correct. And then you wait for that money flow to reverse itself, and it takes time. These things aren't rapid. It's like you're able to see things before they happen. I mean, that's ultimately what's going to happen. And the way that you do that is you go to undervalued assets that no one's in. All the sellers already left. So your downside is limited, and your upside is huge. It's an asymmetric bet is what it's called. So if your downside's limited and you have a huge upside, now you're just saying, okay, now I'm going to try to get really close, as close as you can get, with timing of market conditions of where the money wants to flow back into those assets. And the one thing that pops into my head all the time, it deals with gold, is gold is incredibly cheap in relationship to the monetary base. That chart is burned, that image is burned into my mind. And in the 70s, back then, the money rotated from stocks and bonds into precious metals and commodities. It was a big commodity bull market. And in my opinion, what forced that was a huge real estate cycle boom. The big boom, which is it's basically a demand for credit, went rocketing higher because new homes are being built. And the demand for credit rocketed higher because of the demographics supported a bunch of new homes being built and a bunch of new home buyers. That credit expansion and demand increased interest rates. And I think we're in a very similar situation to that of the 70s. With the millennials coming to home buying years, with us being in a housing shortage, we're going to get a lot more new homes demand for loans against those new homes, which is going to be inflationary, and we're going to push the interest rates up, which then spurs the rotation of money. And that image of gold to monetary base, I think it's going to get revalued up quite dramatically. And we're going to have a commodity boom and a precious metal boom. And that's kind of what I wanted to go over, is you got to understand your strategies. You got to limit your risk on how big your position sizes are. 5% of the portfolio or less is what I kind of do a rule of thumb for each position, and find those undervalued sectors and hold on. Don't let the bull buck you off. You have to ride it from an undervalued state to an overvalued state. So looking at some of these comments, we'll get in here. It says, we haven't broken the trend line, and he's talking about oil yet. We're just coming up and breaking that trend line, which I think we have a lot of runway in front of us in terms of how high this can go. I know a lot of people, and this isn't my viewpoint, I'll kind of describe, I guess. A lot of people, when they look at things, I look at the positive aspects. I say, what's the risks? What's the positives? Some people, all they look at is the negatives. And that just doesn't pay out. It doesn't pay out to have that mindset, to just stare at negatives, look at a negative and be like, this negative is going to happen. It's not going to work. And then you panic out and you sit in cash the entire time. I don't have that viewpoint. I don't have that mindset. I look at things from a much more positive perspective. And then I reduce my risk by diversifying out. So I say, what's the potential upside? And this was at oil. And I know some people probably thought I was crazy. This is at oil when it was like way low, $20, $30 a barrel. And what I said is, they're not putting money into this. And you know what? We don't have the infrastructure in place and the cars in place to do an electric vehicle rollout. It's not going to happen very quickly. It's going to be very slow. Anything that costs a lot of money, it's going to be slow to adopt. It's not just going to be quick, is what most people think. And I said, we're going to have a massive oil problem. And this was at $20 or $30 a barrel. We had the ratio screaming that it was a complete buy and that something was wrong in the oil market. We had never seen ratios that cheap. We never seen oil go to a negative number. So I said, this is the bet to make. I got to put a lot in. So I decided that based off of a potential problem in the future with supply. And I said the demand's probably going to be very robust. Oil is the number one commodity. So my viewpoint was oil could go to $200 or $300 a barrel. Right off the bat, when it was $30 a barrel, I said oil could go way higher, way higher. And everyone else was like, it's never going to go over $40 a barrel. It's never going to go over 40. It's not going to ever go over 40 again. I was like, all right, this is the time to load up because almost everyone's always wrong. And there was no one that was a bull. So I've always bought things when things are down. You have limited downside risk and the asymmetric bet with the tons of upside potential. That is how you make money. You make money by low downside, massive upside. And that's when you got to go big. Not big, not in one position, but that's when you have to invest your money. You don't invest it chasing things. It just doesn't pan out nearly as well. You make far less money. The difference between a cost basis of $4 and $2 is a doubling. But if it goes to $100, I mean, it's a very big difference in how much money you made in that move. So being early and being right is huge. So I look at these things, and we do have some opportunities still out there that can pay out quite dramatically. We are still very low. We're still very early in this commodity bull run when looking at real estate. Real estate's all messed up. We have to build 5 million homes to meet all the demand. I don't know if 5 million homes will be built, but we've got a lot of upside in real estate. We have a lot of loans that are going to be loaned into existence over this real estate market boom. And I think rates are going to go up. So I think people are going to flood into precious metals at some point. I don't know when that point is. I'm not going to pretend like I do. I just know that they're cheap. I know that they're very low. And that if these market conditions play out, which I think they will, higher interest rates, rotation of money into precious metals and commodities, I think we could see something that people's never seen in their life. Maybe some very old people have seen it, but not anyone my age. At 40 years old, there's no one's seen a 1970s bull market. I wasn't born yet. So I think we're going to see something that's very different than the last 40 years. So I wanted to say that. Here's another one. It says, sure, right. We're talking about RECAF. RECAF is Reconnaissance Energy Africa. They could potentially be sitting on a very large deposit of oil. They've drilled 2 wells. They've been successful at hitting on those wells. And right now they're doing a 2D seismic of their property. They're 95% complete, and the quality of the back data received is real high quality for them to work off of on locating the next site to drill. They just broke their downtrend today, and RECAF is another one that I think people might want to look into if you're interested. But they're going to be releasing probably some data from that seismic. I don't know exactly when, but it's probably pretty soon, probably at middle to end, probably the end of October or so. You can check them out on Twitter, and they're always doing updates on there, and that's where I'm getting my updates from. You can also see them doing the seismic on their property. This one says, yeah, I'm fully loaded in precious metals, real estate, and metal stocks. Just to let you know, I'm like 25% precious metals, physical precious metals, 30-something% real estate, and the rest is in equities of some sort. About half of the rest, so I've got a good half in like a 401k roughly, and then the other portion is in this higher risk stuff that I talk about on the channel quite a bit. A lot of these mining companies, a lot of these oil companies, they are higher risk. They are very volatile, and some people can't stomach that. So I just wanted to let everyone know that these things are very volatile, and I'm swinging for the fences. In fact, I'm swinging for the most volatile stuff because if you know what you're doing, if you've got your valuations right, you've got your market conditions right, you're going to swing for the fences at some point, because if your risk is really low, then your upside potential is massive. That's when you swing for the fences. It's when you have all the conditions that are favoring you. So I'm swinging for the fences with the most volatile stuff that I can, and then I diversify out and have position sizes less than 5%. Some only have a very small percentage. I may only put 0.5% or less in some of these very high-risk exploration companies. I do not have a lot of money in the exploration companies. And I think if all you own is exploration companies, you're putting yourself at good risk of missing out on a bull market and those not participating in it. So just make sure that your portfolios are positioned with some developers, some producers, spread it out. Make sure you're getting some pretty good entry points. Follow the channel and the technical analysis if you want, and then hold on for this entire bull market. And I go over ratios, real estate, all these things. And I know I'm not here to tell you guys that this is what real estate, in my opinions on real estate. What I'm telling you is showing you is the market conditions. It's saying these are still ripe. And if the market conditions are ripe, just hold on. We're on the right path. So I'm going to be doing real estate updates every month on stay the path. It's good. And then we've got ratios. Stay the path. It's good. And it's reinforcing, because those are the things I'm looking at when I look at my investments. I'm looking at the market conditions saying they are good. They are solid. They, stay the path. It's good. When those start to change, that's when I have to start to realize, hey, look, the housing market's slowing down. It's time to start, pulling back, pulling the cord on the parachute. It's starting to slow, time to slow down a little bit. But right now, I don't see it. And I know a lot of people, they're gonna say that housing's unaffordable. It has to get unaffordable. This is the least affordable time that we have to come into, because we have a housing shortage. Our inventories are all short. And when you have multiple people competing to bid for homes, homes are going to become unaffordable. And then they're going to get even more unaffordable when inflation kicks up and rent prices go through the roof. And then after rent prices and inflation kick up, your interest rates are going to kick up. They're going to become a lot less affordable. Period. You're not going back. It's going to get worse. Continually worse. And people are going to start looking to buy new homes because the affordability on existing homes becomes so poor that they're going to go buy new homes. And then new homes are going to continue to go up, pulling up the existing home prices together. Or at least that's my opinion on it. And that's what we've seen in the past. It says, in my opinion, you're bang on, Andy. Transition planning was botched in terms of the energy transition and renewables. Oil investment been down for 6+ years. No plan for baseload electricity. From what I understand, you could do about 70% of this renewable stuff. The renewables kick in when we need it the least. Usually the sun is kind of going down, and for solar at least. And that's when we start demanding more electricity usage. So we want more natural gas. That's what we've been using as a transition fuel because we don't know how to store electricity. The way that we probably can store electricity going forward would be hydrogen, electrolysis. And if we store it in hydrogen, then we're going to have a big platinum boom. I also think that silver is another good investment because it's used in electric vehicles and renewables and all this stuff. And I think copper is. So I don't think they can implement as much as they want, as fast as they want, because we just don't have the flow of those minerals for the flow rate that they want for that demand. So the supply can't flow at the same rate that the demand wants to consume it. So coming up here, it says, Andy, do you stack cash for a big pullback or market crash? Or are you buying all the low-valued assets when you can? And when I see an opportunity, and I think it's a very good opportunity in terms of technical analysis and valuations, I deploy money. I don't sit on my money. I do sit on it if I don't see any good places to put it. I don't think a market crash is coming, like a blowout crash. A blowout crash comes when there's a leveraging up in real estate, and then on the backside there's a deleveraging. That deleveraging or deflation comes on the backside of real estate. And real estate, residential real estate, is what you have to watch. If you see residential real estate fall, everything's going to crash. That is what happened in 2008. Inventories in 06 and 07 were building quite rapidly. We got to 10 months worth of inventory before the crash. We had foreclosures all come on. We had too many new homes being built. It all piled on at the same time, and we had a crash. That crash took out everything. At the bottom of the crash, what you wanted to do is you wanted to go into stocks. Stocks would have been a really good play for that entire recovery phase. Now we're later in that move. We are in an expansion phase of real estate, not in a recovery phase of real estate. This is where inflation kicks up, which we're seeing. We're going to see interest rates probably follow that rate of inflation going up. And then you're going to see a lot of the commodities and precious metals do very well at the end of this cycle. It says, Andy, love your content. I'm invested in the same sectors. Aside from Nova Royalty, you don't talk about copper stocks, particularly miners. Is there a reason why? The reason that I don't talk about miners a lot is because they're subject to input costs. So when you take a bet on a mining company, you're betting that their margins are going to increase. And a large input cost for mining companies is natural gas, electricity, and diesel, and all these basically fossil fuels. We're in an energy boom, and the energy boom is going to put a lot of pressure on mining companies and going to squeeze their margins at certain times. It all depends on how fast energy goes up versus how fast their commodity they produce goes up. So I like to play it at a lower risk play. So I'd rather just buy the energy companies direct, straight up, and I think they'll do very well. The mining companies are subject to that your bet is not just, silver going up or copper going up. Your bet is copper going up at a faster rate than oil's going up. And I know that's not a direct relationship, but if it's 50% of their input costs and oil's rocketing higher and copper goes up but not as fast, and they usually don't go up as fast, you're going to see a compression of the margins. So some of these companies do not do well even in a commodity bull market at certain points because their margins are compressing. So I like to play the royalty companies and I like to play the physical metals and eliminate the input costs. That's just me. I'm wired that way. But some mining companies, depending on where they are in their Lassonde curve cycle, will make a lot of money. So if you're developing a mine and you're a single mine and you're going from nothing to production, you're going to make a lot of money. Problem is, there's a lot of risk with that as well. So you're taking on copious amounts of risk, choosing a single mine company, because anything can happen to that mine, and they go from being an amazing paradigm shift of this thing's going to be awesome to, oh no, this mine's not going into production, everyone sell. So there's a lot of risk in a single mine company that can have problems when they're developing the mine, and it can be anything. It could be input costs. It could be risks, technical risks with the project. It could be something with the country that they're in that's nationalizing, or taxes, whatever it may be. But those can be incredibly profitable if you get the right one. The probability of picking the right one in gold and silver is actually very low. So you're more than likely not going to pick a developer that's going to absolutely kill it in this market cycle. There's a lot of duds, a lot of duds. So if you have a lot of money and you know that you can get very good returns somewhere, like let's say very good, like an 8x, you can 8 times your money. Would you rather dump a whole ton of money in the least risk way to play it? Or would you put a whole bunch of money on a high risk play, which most likely is not going to make it? For me, I'd rather put a bunch of money in the low risk. If I know I can get 8x, give me the 8x. I'll take it. I'll do this precious metal swapping game. I'm good with that. I'll put very little money in the exploration companies, even with a lot of research and looking into them. I'll put a little money in all of those, and maybe one will hit. It'll hit so big that it'll drive the portfolio in the right direction anyway. I like taking the low risk, big money bets with the lowest risk way, physical metals, whatever it is, so I can for surely get the gain. You can do that in anything that you want. You can do it in oil, you can do it in uranium, you can buy physical uranium trust or whatever. That's up to you. In that arena, because the returns are so large, I swing for the fences. I swing for the developing companies. If there isn't that many in the sector, I buy almost all of them. I put a little money in each. And I've done pretty well in picking the companies, overweighting the ones that are the good ones. So there's that as well. So I'll stop it there because I can hear the kids. They're running all around up there. So if you guys like this content, give me a thumbs up. Subscribe to the channel if you haven't already. Leave comments below like you guys are. Keep hitting the comment section up. I'll try to answer whatever I can. And thank you for listening. This is Finding Value.